Good morning, everybody. Thank you for joining us for our fourth manager showcase. It's our last one. We focused earlier in the week on everything from the very early stage, the start of SEIS all the way through to AIM and AIM IHT, where you can manage your pension money via some interesting sort of credit vehicles. Today I'm delighted to be focusing on EIS, the very core of the sector, and we've got five very interesting and diversified funds that we'll be focusing on today. Just a little bit of housekeeping. This is scheduled to last 1 hour. Each of the guys are going to speak for 8 minutes. There is a question function. You'll know the scoop by now on Zoom, I suspect, of how that works. And if we can't answer your questions, then we will get back to you on an individual basis after the session. So the four managers we're talking about today the 5 managers we're talking about today are all available live on our platform. You can simply and easily build up your own diversified portfolio of investments. And just to confuse everybody, there are 3 Jameses in the room today, so that should make life slightly interesting. So we have James Saw from Superseed, we have Paul Mattick from Mercia, James Faulkner from Vala, Andrew Noble from Par Equity, and James DeMello from the Side by Side Partnership. So good morning, everybody. What we'll do is we'll kick off proceedings straight away with James from Superseed. So James, the virtual floor is all yours, sir.
Perfect, thanks very much. So I'm James Saw. I'm principal at Superseed Ventures. So we'll give you a quick introduction to the fund. So firstly, thanks very much for taking the time out of your day to join us. Obviously, everyone's getting more comfortable now, hopefully, with doing these types of virtual sales approaches, but we shall see how we get on today. Hopefully, going to give you just a brief overview of what we're up to, what we're building as a fund, and a little bit around the structure of the fund as well. So we're Superseed. We're an early stage venture fund with a clear conviction that startups to apply emerging technologies will transform the way that business works, and that these startups will become powerful engine of change for the next decade. We invest in technical founders solving real problems with unreal ambition, building software that informs, empowers, and inspires. We like founders who are consumed by creation and the customers that they offer their services to, and possess restlessness and resilience to start up and stay the course and maintain that belief that they can change the way that business works. Now, this may sound like bold ambitions, but if we're honest, probably something you've heard lots of entrepreneurs claim before. Entrepreneurs are, as you all know, inherently ambitious people aiming to change the world, but early stage investing comes with the ever-present risk of failure. When designing the fund, we focused on what can be done to reduce this investment risk. Do you know that the #1 killer of startups is actually poor product market fit? Put simply, building products and services that don't focus on what's actually needed in the industry, what the actual market needs. Superseed was therefore structured differently. We focus on product market fit and sales very early on in the investment review process. We interview existing clients to see how they're using the software. Is it being used in earnest or simply a sort of proof of concept with little engagement, for example? We organize new sales leads and calls for the potential investee company, which we either shadow or attend ourselves. We also use our extensive network to further test market demand by reaching out to future potential clients and gauge their feedback and insights directly. We always remember that no matter how big the vision or how strong the idea or how powerful the technology, a company's success is predicated on how well it can sell and how well they can go to market, gain customers, and seize ground. Ultimately, getting from great product to global market fit. Our belief in the power of sales is so strong that we actually start selling before we invest. Founders get to evaluate our relationship with them while we validate the market, proving that powerful partnerships deliver more than money. All of this additional information flows into how we make our investment decisions. This focus on sales sits in addition to the more traditional due diligence processes that other funds will employ. This early insight into whether the market really needs the technology, we believe, helps us reduce investment risk and improves our chances of success. We focus heavily on product market fit, but what else sets us apart? We invest early. We know firsthand that building the future is no easy feat. Getting the business off the ground, going from 0 to 1, is tough enough. The leap from 1 to 1 million recurring is even more demanding. Many B2B SaaS and deep technology funds prefer to invest at a later stage, Series A, for example, when the company is more established and revenues are larger, for instance, 1 million annual recurring or above. Investors can sometimes fall into the trap of using these revenues as a proxy for risk, which we believe is wrong. We like to feel comfortable with the team, the technology, the scale, and the product market fit before investing, but prefer to invest early when valuations remain attractive. We're building the fund we always wanted to be backed by, actively supporting our founders to accelerate sales via the expertise we've gained, the experiences we've shared, and the errors we've made. In summary, we focus heavily on assessing if there's good or great, ideally, product market fit, and we invest early when valuations are more attractive. So who are we? In the US, 60% of VCs are entrepreneurs, either founding or working in startups. But it may be surprising to hear in the UK, this figure is only 8%. Superseed is different. We're entrepreneurs investing in entrepreneurs. We find that having been founders, we have a unique appreciation for the pressures and challenges CEOs face. And we can use our experiences to advise on how to, hopefully, as one portfolio calls it, see round corners. We've built and sold, failed and scaled, entered new markets and expanded teams and exited companies. We've authored patents, structured deals and generated hundreds of millions in sales. We've lived through the booms and the busts and the bubbles and the COVIDs. We've seen that what works and what doesn't and why. Ultimately, we know how to create winning businesses. So the team includes myself. I'm a mechanical and electronics engineer with 15 years experience in technology. I've been investing and/or managing funds in the early stage investment space for 10 years, and have invested in over 80 companies to date. Mads Jensen's a partner who's 20-year track record in technology as an operator, founder and investor, an ex-IBM executive experienced in technology, operations and M&A. At IBM, he delivered in excess of 100 million in revenue across 500 customer firms. And after leaving IBM, more importantly for our fund, he founded and subsequently exited a B2B SaaS company called Sapphira. He sold that to the $12 billion Californian giant Trimble. The other partner, Dan Boya, he's a serial entrepreneur who's founded, scaled and exited 2 startups, as well as achieving exits in a further 4 investments. He's been a successful operator across many sectors, such as publishing, analytics, retail, and FMCG. Dan has also a 20-year experience as a technology operator, investor, and mentor. Our venture partner, Daniel Pitchford, is an AI specialist. Dan co-founded the world's first and still the largest AI news platform and events company called AI Business. I suppose when you found the first one, you can call it what you want. He founded that in 2015. The company underwent massive expansion and was sold to publishing giant and FTSE 100 company Informa PLC in 2018. So the partners have achieved 8 exits already, 4 by investment and 4 by entrepreneurship. So that gives us a good grounding to understand what we're looking for and how we can help those companies post-investment. Just like to give you maybe a flavor for at least one of the companies. I know not got vast amounts of time, but an example company in the portfolios most recently invested in was AI Build. So they sell to the manufacturing industry. Specifically, they help manufacturers make very large components using 3D printing. 3D printing is extremely useful because you can build a custom component at low volume, but the errors stack up very quickly when you're moving at a large scale. So the company's created an AI platform that automates and accelerates large parts of the 3D manufacturing process. It does this by pre-optimizing 3D print jobs, and then once the print is taking place, auto-correcting during manufacture. This dramatically reduces downtime and also input from human error. So our fund is an evergreen fund, so we're open to investors all year round. We aim to build investors a portfolio of 8 to 12 investments per year, and we look to have clients' money invested within 12 months. For those who wish to invest in a fund, the minimum investment is 25k for direct investors, and for advised clients, the minimum is 10,000. I believe that is my time. The rest of the details on the fund you can find on CoInvestor.
Thank you, James. Just to help answer some of the questions that come there. So, what does your fee structure look like?
So we have 0 to 2% on initial fee, depending on investment amount, and then the annual management is 2% to 2.5%, again dependent on the amount invested. We take the charges for 5 years, but we only take 3 years up front. We have a relatively standard 20% performance fee on 1.2 times return on capital, including fees. So we have to deliver fees back.
All right, thank you, James. And just lastly, what's the size of the fund?
2.5.
2.5. Okay, thank you. All right, thank you, James. So next we'll go over to Paul Matic at Mercia. So Paul, the virtual floor's all yours.
Great, thank you very much, and thank you for allowing me to present to everyone here today. So similar to other funds here, we are entrepreneur backed, and but Mercia itself, we are at scale. So we are one of the largest early stage technology investors in the UK. I think that's a good starting point to understand. We've got about 900 million under management, and we have delivered back exits to clients in over 300 million pounds. So that gives you an idea of the type of scale that Mercia is operating at. And I think we have 100 staff around the country, 8 offices. So and we're recognised by Bowhurst and PitchBook as the most active VC in UK, or actually in Europe. And so again, that just re-emphasises it. And on the tax side, we have both VCT and EIS here. Speak about EIS today, and we have really some of the leading scores from independent reviewers from both Martin Churchill at 87 and Alan Bridge at 86, which kind of gives everyone an idea of where we're sitting within the market. So just straight up front, I know the questions will come in at some point about fees and fund size, etc. So the EIS fund is around 60 million out of the 900 million under management, and our fee structure is pretty standard. It's 1% for existing investors, initial fee, 1.5 annual management, and 20% performance fee. And we deploy in about, on average, at 7.8 months into 12 to 15 companies. So I thought, let's get that away at the start. So that's kind of the questions that will come in around that. But so we talked about the size already and the structure. What do we actually do? So we invest from seed through to Series A within the EIS fund across multiple different companies, as I stated. The way we invest is we put a small amount of money into companies initially, and then we can follow on progressively as the companies prove their model. That's partly how we create these 12 to 15 companies portfolio. But what we're aiming for is to triple invested capital. So 5 to 7 years, so say 2.5 times on actual cost, and then add the tax on top of that is how we present it. And to deliver that, we are creating these companies, investing early stage and looking to get exits from 5 times cost up to 10 times cost, and in some cases in excess of 10 times cost. And that sounds pretty difficult, but actually Mercia has been able to do that a number of times. And the last few months, we've had 2 8x exits from our EIS fund. And actually in the last year or two, we've had 104 times cash return on one of our investments in a company called Blue Prism, which in AI, and another one in 26 times in a company called Linear. So these kind of targets are perfectly achievable for our group, and we have a track record of delivering it. In terms of the actual sectors we invest in, so we're not so specific about the sectors. We will look at any sector that we have expertise in. So we have in-house entrepreneurs, and they can sit on the boards that in companies we invest in and help build the companies. We are operators entrepreneurs who've turned into investors within the house across different sectors. The 2 sectors we're investing most in at the moment is software as a service, so internet generally, but and also the medical devices and life sciences. Those two areas are places where we have in-house expertise, and one of our directors has built and sold a company in specifically a very small niche tech of spinal technology, medical devices. So we have a lot of companies we invest in that sort of space. We look at anything. We've got 400 portfolio companies across the group. So we any sector you can think of, we've probably got a company in it, and we've managed to support these companies from some cases even idea stage. So on occasions we do help set up companies in-house, and then bring in some IP and a management team, bring them together, give them a bit of funding, and then help them progress along the track record. And often the companies which we're seeding in-house and supporting along the journey are the ones that actually fulfill really substantial potential. And we have companies in our portfolio, EIS portfolio, in excess of 10 times cost now. And that there's a number of companies we'll speak about in a second. But so sector specific, not so much. One thing we are focused on is the geography. So we support companies primarily outside of the southeast, especially in the Midlands and North and Scotland. So we've done, I think, £40 million of investment in the last 6 months, and none of those companies have been inside London. So that gives you an idea of the geography. We manage some of the British Business Bank money across the Midlands, the Northern Powerhouse, and the North East Venture Fund, which helps support the EIS cash going in. We can leverage it with the other government's other money from the British Business Bank. So that's in terms of geography. One thing we are, and part of the reason we are focused on geography is the valuations. So what we are finding is that there's a lot of capital chasing software companies, especially in London, and you see a lot of investors looking to deploy cash into London-based companies, which means that the prices spiral upwards, and that's something which we don't want to get involved with. We think the pricing in the southeast normally is inappropriate and doesn't deliver an investor the return that required. So we as part of the reason why we do invest in the Midlands and North is that there's less capital available, and Mercia is out there finding early stage companies, supporting them through their growth phases with our in-house expertise, and then helping them realize the full value. I think geography and valuation are key to what Mercia does, in addition to the diversification, which I've really talked about. We always are looking for the exit points, and as I say, we have sold 2 companies in the last 3 months over 8 times cost, taking some of our EIS investors into performance fees and above cost, which is what we all want from investors, for our investors. So just looking at a couple of portfolio companies which might be of interest at the moment, we have, unsurprisingly, with a big portfolio, we have some companies which are investing in COVID diagnostics. We have one specific company called Sense Biodetection, which has been working on virus detection for virus and bacteria for the last few years, and had a breakthrough in 2019. And since then, we've built up the company. We've brought in some institutional investment, and last month we had a $50 million investment into that company. So this is one of the companies which we can see got massive potential at the moment. It's a platform technology, so it can enable our investors to get a great return, but also help get us out of this COVID situation. So there are other various other companies which are doing well, but that one's held it up to it's 10 times cost. We have other companies similarly in that sort of position where they're going through the breakthrough phases. So for Mercia, we always have a fund open. We are evergreen. We've got quarterly closes. We deploy within 7.8 months on average. From there, we look to triple invested capital in 5 to 7 years. I don't want to spend too much time, but I think that for me, Chris, is
yeah. No, and I think you've covered quite a lot of ground there, Paul. Thank you. And just a couple of questions that have come in. Do you structure your investments as equity or debt, or is it a mix, or is it on a case by case?
Obviously for EIS, it is entirely equity. We have other funds which can do debts, and but The way we invest is that we put EIS in first, or normally sometimes SDIS, then EIS, and then we have VCT, which can invest afterwards, and our PLC as well.
Okay. And do you take board rights in the companies, or how do you control or influence the investment?
So we're on every single company's board. When we first invest, we're always on the board, and we often build up positions that could be 20, 30, 40% of equity as we support companies over time. So we sometimes have the right to take multiple board seats, but we are very active, and that helps us, the management teams, and they can rely on us to think of us as a support network rather than just cash.
Okay, thanks, Paul. And lastly, what's the minimum investment?
Yep. So minimum is 25,000. There is some flexibility around that, and we much prefer to work with investors over a longer period, over a number of years, rather than to have a one-off investment, because we think that gives better overall returns. So yeah.
Okay. All right. Thank you. Thanks, Paul. So next up we have James Faulkner from Varna. So James, over to you.
Great stuff. Thank you. Thank you for the opportunity. There's going to be, and Chris, if I miss any of the points that people are looking to pick up, I'm sure you'll pick those up. There's going to be a bit of a flavour, I think, running through these discussions and presentations. We too come from an entrepreneurial background, and I think it's an important part. It's perhaps one of the changes that's coming through in the industry as entrepreneurs get more and more involved, and that should lead to better outcomes. People who've had the experience over many years of building, conceptualizing, building, exiting many businesses has got to be a positive in terms of the development of these businesses. And that comes back to the why Varna for us, which is a group of seasoned, experienced entrepreneurs who over 20 plus years have been working together in building companies, and within sectors that they've identified with high growth potential, and building and adding into that the investment disciplines one needs in order to make sound decisions. We also then take a very simple and balanced approach to fees, and I'll share those as we go through the two EISs. We offer two EISs. There's a common thread that runs through the things that we do, which I've mentioned so far. But the background to the team, and it talks about the track record there, and that's not the totality of their corporate background, their of the founding partners. It's much greater than that. But this identifies their track record in commensurate investments, i.e. investments that would fulfill the risk to capital condition. And we've identified 53 companies that between the four founding partners, and you can look them up on the website, or we can talk about those another time, but we've identified 53 investments that they've made within this kind of area of investment, and of those 35 have exited for good, and for some of them not so good, but the aggregate return, so there's been 48 million in total been put into those 35 companies, which includes their own capital. And that 48 has been turned into 143 million across those 35. So that's not cherry picking, that's the total. And you can see what that experience is going to bring. We think that's an adequate, more than adequate track record, but also a decent model for how we think the EISs are going to perform. We've got two EISs. The Varna EIS portfolio has completed 6 tranches across this particular strategy. It will be completing a 7th before the end of the tax year. So it invests in tranches. So somebody deploys their capital, application's been accepted, and we look to deploy that. Well, in this case, fully before the end of the tax year, into 6 to 10 companies. So it's typically been sort of 7, 8, or 9 in each portfolio. And the benefits of the Varna EIS portfolio is first of all that it's quite predictable in the way that it invests. So one of the things that we're able to do is share with investors or prospective investors the list of companies that we expect to be deploying their capital into. So it's nice and predictable in terms of when those deployments are going to be made. So investors have some reasonable idea of when they're going to be able to get their EIS tax benefits. It's led, the investments are chosen and mentored by this group of serial entrepreneurs with this very strong track record. Who better to be doing that than this particular group? And as I say, we build this around a low fee model, and that's done very deliberately. First of all, because it's lovely and simple, but also it's very light, and it's done that way because we believe that's the ultimate incentive to achieving profitable exits. So we do that by charging a one-off 6% fee to the underlying investee companies. So on behalf of the investors, so that means 100% of their investors' capital can be invested into the companies. So we charge 6%, and then there are no other ongoing fees for the lifetime of the investment through the Vala EIS portfolio. And then we'll take, as James was saying, a fairly typical 20% on any profitable exits after that. So and the minimum investment for that is 25,000. It's been running about 2.5 years. We've invested about 7.5 million through that portfolio so far. So we're on track. We've got a number of interesting companies in there. Perhaps Playworks would be one that's a particular note, growing very quickly, has had an interesting COVID period where it's been growing even more rapidly and is now in some interesting discussions with external investors, which is pretty exciting for Playworks. Similarly, there's a bakery company. It comes out of the portfolio of one of the investment directors, Paddy Willis, and that's again having had an interesting 2020, as perhaps we all have had, is also in discussions with an external investor, which is again exciting times for them. So it's a diverse portfolio, but the portfolio reflects the expertise of the investment partners behind it. The other EIS then is the Sustainable Growth EIS, which is we've just recently launched, which is exciting, which is offering investors the opportunity to invest in companies innovating in targeting innovation and developments within the challenges around the environment and sustainability. And we've identified 3 particular themes. So that's technology for planetary health, so reducing fossil fuel dependence, innovations in energy production and consumption. How do we make things more efficiently and more cleanly? Sustainable consumerism. How do we help consumers make informed, sustainable choices? What are the developments in order to make products that last longer and create less waste? And the final theme is how do we give our growing population fair access to education and capital and some of the basic needs around food and water and sanitation. So the sustainable growth is about delivering strong returns, but the company's growth in value will be directly linked to its efficacy in how well it performs. So it's targeting strong returns. It allows investors to put capital to work in a way that can contribute to tackling big environmental and social challenges. And it's managed by a team that combines that entrepreneurial experience, which I've spoken about quite a lot, with deep sustainability expertise. And we added quite a lot to the team that bring those particular sustainability disciplines as well. And if you want to know a bit more, there's more on our website, and also a number of companies that are identified for the pipeline. Again, portfolio size 6 to 10 companies. We expect to be deploying over around 12 months. We think that's reasonable, and the minimum investment is 25,000. The fee structure is slightly different. There will be an initial fee, again, charged on behalf of the investors to the underlying investee companies, but we also will be charging a 1.5% AMC to the investors. We'll hold back the first 3 years of the AMC, Years 4 and 5 will be accrued, and then there are no AMCs after year 5. And then again, we have a 20% performance fee over a 10% hurdle. So I think that's about the rattle through.
Yep.
Was there anything else that I've missed that you wanted to cover?
What's the sort of typical investment size into the businesses, and whether you're also taking a sort of a board role or on the firms?
Yeah, we certainly typically expect to be putting somebody on the board. I think there are 1 or 2 companies in the portfolio. I don't think there are 1 or 2 companies in the portfolio that we have observer rights, not a board seat. But generally, we're going to be investing in companies where we can add value into the business. They're not going to pay our initial fee, unless we are providing significant benefit into that business, which would include somebody being involved in that business, not at an executive level, but as a non-exec, as a mentor. So typically, we would expect to have somebody on the board. The initial investments may be as little as 200,000, but we typically write a term sheet at the beginning of the arrangement, which could be up to $1 million or $1.5 million, but deployed over a series of tranches. So it depends on the nature of that term sheet. So individual chunks of capital might be as little as, say, 200,000, but the term sheet will probably be written for $1 million or $1.5 million.
Okay. Well, nothing will motivate those companies to hit their KPIs like knowing that there's more money available if they do, I suspect. So,
quite so.
Yeah. Okay. Thank you, James. Thanks for that. So next I'll be handing over to Andrew Noble in very cosy looking Scotland. So welcome, Andrew, and so the floor's all yours.
Thank you, Chris, and thank you to everyone for joining us today. Very much appreciate you giving up your time to hear more about all the managers, including Par Equity. Pleased to say that, when you're looking at EIS, Par Equity is one of the most experienced and also successful EIS managers in the market. And so over the course of the next 8 or 9 minutes, what I'll intend to do is just give you a bit of an overview on our focus. I'll talk a little bit more about our investment activities. And of course, it's not just about putting the money in, it's also about getting the money out. So I'll talk about our performance. I'll talk a little bit about COVID-19 and how that's positively impacted our portfolio. And then I'll mention the sort of EIS fund structure that we have and what that means to you as prospective investors coming in. So in summary, Par Equity backs outstanding entrepreneurs, and through the power of our network, we help them build world-class companies in the north of the UK. And I think that's really important to demonstrate, because that sentence largely encapsulates what we do at Par. Our focus is on the north of the UK, so that's Scotland, Northern Ireland, and Northern England. And the reason for that is that we're based in Edinburgh, and we like to be close to our investments. We're hands-on active managers. We want to have an influence on what they're doing. We know that we can help them. We know that we can turbocharge their activities, and we know that we can get them to successful exits. And that is really important for you as the investors. In terms of our focus, we tend not to do much in the way of consumer-facing tech propositions. The reason for that is that it tends to be slightly harder to get those businesses to break even. They tend to need a lot more capital to grow those businesses. And instead, we focus on enterprise tech, health tech, industrial tech, pockets of e-commerce, pockets of e-gaming services. And that's the sweet spot for us, because we tend to look for companies that have some patents behind them, some deep learning curves, some form of defensibility, where we can build an interesting investment case in order to support that company through to break even and then through to a successful exit. In terms of the stage of companies that we support, it's largely seed to Series A. And what I mean by that are companies that are well into commercial traction. So generally, on average, we'll invest into companies that are turning over about £70,000 per month. And so that means they're getting towards a £1 million revenue run rate. So these are businesses that are proving out demand for their new technology, but they're still finding product market fit before they scale or before they move into break-even territory. And that's where we think we can help the most. In terms of the check sizes that we write, it can be anything between $500,000 and $2 million. And we do like to follow our money extensively. So a lot of the companies that we've exited, we might invest maybe 2, 3, 4, even 5 times before we get that company to a successful exit. In terms of our USPs, well, really, it's the power of our network. We have quite an extensive network, not just across the north of the UK, but globally. And we use that extensively throughout our investment process, from deal origination, due diligence, portfolio management, and all the way through to exit management too. And that is critical to our success. It's how we can wrap experienced entrepreneurs around our businesses, supplying them with the right people at the right time. I'll drop down into some of the numbers on the slide in front of you. I think they speak volumes for our activity and our performance. 87% of our investments are in the north, so just underline that focus in the north of the UK. 61 companies back to date. We've realized 21 of them, so we've already realized a third of our portfolio. So we're holding 40 portfolio companies. 240 EIS qualifying investments to date, and every single one has achieved its EIS 3 status, I'm pleased to say. So bags of experience within the Par Equity team. And another important stat is that 3.9 million of capital has been personally invested by the Par team into our portfolio companies. So that shows a high degree of alignment, I hope, with you as prospective investors coming in. And it means that we're very much incentivized to get the right results. Indeed, all the partners at Par Equity have the obligation, not the right, to invest into the EIS fund every year. So we're very much aligned with you and your clients. But it's not just about putting money out the door. It's also about getting it back. And what you'll see on the right-hand side here is our realized performance across Par Equity's portfolio. So 21 realizations, that's 125 investment rounds that, that we've now realized. So if you're looking for statistical significance in a manager, we've certainly got that in bucket loads. And the investment cost across those 21 realizations is 23 million, and we've returned 89 million so far back. That is more than the total sum of money that we've invested across all 61 companies. So quite staggering statistics that the team have been able to achieve so far. That is before any tax relief to investors. And that comes through at a 27% IRR. So when you think about the returns in VC on average in the UK are averaging around about 13% IRRs. In the US, it's about 15% IRR. We're well above average at 27% IRR. So the performance has been very, very good. Thinking about COVID-19 and also the performance of our underlying portfolio of 40 companies, well, actually, we're really pleased with how they're developing. COVID-19, because of our investment focus on enterprise tech and health tech in particular, has had a positive effect on our portfolio. In the last quarter alone, our revenue across our portfolio has on average gone up 77%. So quite staggering growth as a result of COVID-19. And in addition, across our 28 portfolio companies that we held at the end of the quarter, September 30th, 8 had unsolicited acquisition interest in that quarter, and 3 more had unsolicited acquisition interest in the first few weeks of October. One of which Symphonic sold in October for 9.5 times money for early EIS fund investors. And in fact, our first 2 tax year cohorts from EIS fund investors are now sitting at 6 times money across their portfolios. So really, really good returns. In terms of this fund structure, you'll be interested to know. So the minimum check size into our EIS fund is £20,000. We invest that across 8 companies. We target deployment in 12 months, but actually our track record shows that we're deploying that on average within 10 months. And even over the last year, we've done that in 8 months. So lots of good deployment activity and a good pipeline of opportunities coming up to continue to deliver on that front. In terms of fees, finally, we charge a 1% initial fee and a 0.75% AMC. Both of these are inclusive of VAT, It's something we feel quite strongly about, that as a retail proposition, all fees should be inclusive of that. And our performance fee is 20% performance fee, also inclusive of that as well, above a hurdle rate of 1.2 times the subscription amount that you or your clients have invested in. So I hope that's helpful as an overview. Happy to take any questions as we go.
Yeah, Andrew, just want to, I mean, you're quite specific on the companies that you're approaching. You know, when they're approaching the sort of 1 million revenue mark. Do you have a sort of standardized framework for valuing these businesses, or how do you go about valuations?
Yeah, it very much varies on the underlying company. It's not as easy as saying, oh, well, it's a software business and this is the rate of growth and this is the underlying ARR. A lot of the companies we invest into, many of them are engineering tech businesses, for example. They have a lot of underlying IP in there as well, and that needs to be considered when you think about how to value a company. What I would say, though, is that over the last 12 to 18 months, when we look at the underlying revenue of a company and the valuation as a multiple, the average multiple that we have when we've invested into companies is around about 5.6 times revenue on a run rate basis. So we're getting into companies at a very, very good value compared to those companies that are perhaps backed by, you know, they're operating in the Southeast and are backed by Southeast managers. Okay.
And is that sort of, when you are investing, is that a mix of debt and equity, or do you have a specific?
No, absolutely not. We invest purely equity. Okay. We will look to always invest ordinary shares if we can. If there's a preference stack already in the business, then we will match that to the extent that it's EIS qualifying.
Okay, and a question from the audience actually is, who are your co-investment partners? Who are they?
Yeah, so we have co-investment partners with the Scottish Investment Bank in Scotland, obviously. So we're able to draw down their money on match basis on specific deals that we're working on, and that's an option to us if we need that money. In addition, we recently signed off a £50 million pledge capital commitment from the British Business Bank to support our investment activities as well.
Okay. And do you work with, again from the audience, do you work with external due diligence partners?
We tend to do most of our due diligence in-house, to be honest. So all of our commercial due diligence is done by our team and our wider investor network. We do not outsource that because it's absolutely critical to our model. And we want to get very, very comfortable that this team and the opportunity has the potential for huge success. So we don't outsource that. The only thing we do outsource is obviously the legal diligence and potentially some management diligence as well, if we need to bring in someone to do some HRDD as well. Okay. And maybe some tax diligence too, especially around EIS. But other than that, the vast majority of DD is done by us and our wider network.
Okay, thanks, Andrew. And if anyone has any further questions, then obviously we can put them in touch directly afterwards as well. So last but hopefully not least is James Mello from the Side by Side Partnership. So James, I think everyone's quite interested to hear what you've got to say. So over to you.
Thanks, Chris. Good morning, everyone. Thank you for bearing with us to the last one, I guess. I'm going to say some things that probably won't shock you by the fact that, as you've heard from many others, we are entrepreneur-led fund. An entrepreneur-led fund, rather. We are operators rather than finance people. We utilise both aspects of research, but typically our management team have been through either the entrepreneurial type journey and founded and built or turned around companies. It won't surprise you to match a theme and say that our companies have done well. EIS companies are typically sort of smaller, more agile, and all the other cliches, so they haven't been sort of immediately stumped by COVID. And we invest in tech-enabled, which probably could mean that they have a laptop in the office, but more importantly for us, it's the fact that they might be doing anything. Our portfolio companies range from a golf piece of wearable technology for golf right through to laundry. So it's a business that could be in any sector as long as they're utilizing tech in a way to exploit whatever it is they need to do. Past performance is not an indicator of future performance, and financial services is probably the only place people really say that, because anywhere else, past performance would be taken into consideration. So whilst we are a new fund, our management team is built up of sort of a group of very successful people, and I'm not including myself in that, but some of the others. So our founder, John, has sort of his first business was they invented something known as CRM, and it wasn't Salesforce before anyone gets really excited. Salesforce copied what John did, unfortunately, but his first company founded a CRM, grew it, sort of took it over to the States and ended up exiting via a NASDAQ listing. That was the first of one of many kind of, you'll hear again, another cliche in terms of serial entrepreneur. Our management team have been in and out of over 40 odd, either building, founding, or investing in other companies and funds. The ROI for our directly managed businesses from the past performance rather than the current fund is currently sat around 46.6x. And I have a big list of figures that I can send through to anyone that's interested after this. The fund is relatively new, so we launched our second fund in August of this year. So the minimum ticket size is £10,000, and we typically deploy into around sort of 3 to 5 companies per round. The big difference for us, and as you can see from here, about unapologetically selective, the companies we target, and again, you've heard lots of different terms about seed and later sort of Series A, Series B, and they all tend to mean different things to different people. We target what we call later stage businesses. Now, our companies are already producing at least £1 million of annualized revenue before we go in. That's, for us, a way of reducing the risk of the startups, the sort of startup risk to a business. Our companies are typically getting to a stage where they've probably realized that maybe their mum isn't right to be head of HR, and maybe their friend from school that was good on a computer shouldn't be their head of IT anymore. Typically, they're starting to outgrow their typical infrastructure. So for us, the later stage means that, and don't get me wrong, it's very exciting to back kind of the next big thing, you know, the guy or girl working from their shed with a really bright idea to change the world. For us and for investors and for advisors, the added volatility of the early stage startups just isn't where we wanted to position ourselves. We're hands-on, everyone's hands-on. We take pride in the fact that we sit down with our companies at least twice a month. We don't just kind of stick some money and turn up for a board meeting every now and then. We work with the companies because, like kids, although I've heard, like kids, EIS and other companies take a lot of support. They need nurturing, they need sort of introductions or whatever it may be. It's also the fact that from EIS and VCTs that you've heard before about performance charges. So we don't charge any initial or annual management fees to investors. Much like Viola, we charge them against the companies. The main sort of performance fee that I think advisors and investors really need to be aware of is the hurdle. Now, unless anyone's changed theirs in the last 48 minutes, we have what's called the highest performance hurdle on the market, which means we do not start to charge performance fees until we have returned at least 150% of the overall portfolio. We don't charge it per company, we charge it on the overall amount that the client invests with us. By not charging the initial and the AMCs to the client, it also means that 100% of what's invested with us qualifies for tax relief. We aim to return 3 times capital after sort of between 5 and 8 years. The 3x doesn't include tax relief because, as much as I'd love to take credit, it's HMRC's job to do that. So the 3x is purely on investment returns. And as I said, we don't charge a performance fee until we hit the 150%, at which point we have a 30% performance charge. We have skin in the game, just like everyone else. Our entire management and sales team invest into the fund in each round on the exact same terms as investors. We do not do preference shares, liquidation rights, any of that. Believe me, we fill out the exact same application form that you guys have to. So yeah, on the exact same terms. The later stage, I've covered the management team. As I said, we've had some very sort of big successful companies within the management team. Happy to send some bits through on that. A couple of things that I think are worth sort of bearing in mind for advisors, but also investors. When you're looking at these EISs, VCTs, SCISs even, diversification, and I know it sounds cliche, is your friend. Side by side, the other managers you've heard from today will all form part of a well-balanced portfolio. Investing in different funds and mixing technology, life sciences, whatever it may be, and having some different funding state, the kind of, as I said, the guy or the girl in their shed type companies versus the more sort of later stage, will overall give you a sort of decent portfolio return. Supporting sort of advisors, we realize that everyone's digital now and there's applications. Obviously, everything is now available online. However, one of the biggest things with our sort of fund is making sure that we get the sort of returns that you would expect. The way we do that is by making sure that our valuation process, because I've just seen that pop up in the questions, our valuation process is that we only utilize third-party valuations. We don't rank or value our companies ourselves. We will only change the valuation on our companies if they receive external investment. So you may not see them change as typical as some, but when they do change, it will be because the company has raised further financing. And the other thing is also the fact that because we are so heavily intertwined with the companies and supporting them, we deliver quarterly reports on all of the investee companies. All of the side-by-side team are involved with each company. So no matter if you call myself, one of my colleagues, we should be able to answer any questions you may have. Overall, I think someone else mentioned it, but all of our investments to date have qualified for EIS and have received their EIS 3 certificates back. That's something that's obviously always a chance, but as long as a company has advance assurance, that's something that we deem necessary before we invest. And from an investor's point of view, EIS certificates taking on average about a month and a half. I think the fees, there's none to the investors. We charge 5% to our companies and 2% AMC. Minimum investment size is £10,000. We're obviously available on the CoInvestor platform, as we are here anyway. And I think that's it.
Thank you, James. There's a couple of things. One, what's the target size of your fund and how much have you raised to date?
So the target raised to date is 1.5 or 1.49 to be exact, because we deployed capital on Monday of this week. The current sort of target raise, we were targeting probably another 1.5 by the end of the tax year. And because we invest and follow on with all of our companies, so we self-limit the fund. Sounds like we have a problem with too many companies, but we self-limit the funds to around 12 companies, because as anyone can work out, if we're spending on average twice a month with each company, there's only so many hours in a day and so many days in a month. So we will typically invest on that sort of basis, and each company that we go into, an investor that comes in today and then follows on next year and the year after will tend to see different rounds into the same businesses, along with new ones too. But typically 3 to 5 companies per deployment.
Okay, thank you, James. Lastly, just before we reach the hour, I wonder if I could just ask you all individually. You've all talked about a lot about what you've invested in, and I guess if you could all touch upon, is your investment philosophy going to change? And what do you think the world's going to look like? Dare I say it? If I can say it, I may be jumping the gun a little early. In a post-COVID world, with the vaccinations now looking likely, and I think actually arriving in the UK now, I think we start to look forward out of what's been an exceptionally strange year. I just wondered if everyone could just spend 60 seconds on what they think what's the post-COVID world going to look like, or from the UK perspective, and where you're actively investing. So I wonder if I just start. I wonder if I can ask James at Superseed. Your view on that.
Nice little small question there. What's the world going to look like? So I mean, from a sort of macro perspective, there's the huge pressures on real estate. Do people actually need all these? So the way that people work and where people work is going to be under significant pressure. I think that from our perspective, us focusing on SaaS and deep technology, that software provides a way to scale and integrate efficiencies within a business in a lot more effective way than maybe sort of hiring different people and trying to bring in different skill sets. So actually, we've seen quite a big uptick in people taking the punt on new bits of software, as it were, and testing it out. Without people also in their offices, it does mean that implementing new things has become easier. I also think that that we will still revert to real, I call it. So the initial outreach, for instance, with sales, we've seen a number of our companies make big improvements in the way that initial outreach has been accepted from things like LinkedIn, etc. then having initial sales through Zoom and all the other providers that have now sprung up is increasing, but I think you will still need to move to real. So I think there will be a change in the sales process. I think we'll get a lot more digital first interaction, but I think people still want to go to real events and meet real people.
Okay, thank you, James. And Paul, could you fancy taking a short stab at the question?
Sure. I think there'll be lots of repeated answers anyway.
Yeah, maybe.
Yeah, there's lots of areas which are going to benefit. Obviously, e-commerce generally, actually gaming specifically, which I'm sure Valo can talk about. But so it's a space we're in as well. But medical devices, diagnostics is the obvious one for us. And I think it's almost, we're now at the stage where we want to be exiting those companies rather than investing into them. Obviously, be high growth, but it takes 5-10 years to build a big company. So we've already got a portfolio within those spaces, especially within medical devices and diagnostics. But I think everyone knows we're working from home more, and there's going to be more e-commerce. There's nothing surprising there. Just when the vaccine comes in, I don't think it's going to be simple. I think it's going to be 2024, 25 until we actually get to the post-COVID period. And at that point, there might well be a big world rally, because it's been suppressed for a number of years from COVID. So post-COVID, I think will be pretty buoyant times.
Okay. Can I add a rather technical bit to this as well, which is just a reminder that it's one of the advantages EISs have over VCTs, where VCTs are an existing group of companies which could have really successful companies, but also companies that have really struggled, just generally, and because of the coronavirus, where EISs are always new portfolios. So as managers, we should be making decisions to invest only in companies now that are doing okay. We're not going to put more money into companies that have been, whacked by this. And we're only going to put more money into those companies if they've then shown subsequent growth. So it's always new companies with EIS, or new dollops of money going into companies. So I think there's a bit of an advantage EISs have over VCTs in this particular sector.
Okay, thank you. And Andrew, what's the view from Scotland in how's post-COVID going to look like from your perspective?
Yeah, I mean, I don't think it makes any difference where you are based in the UK in terms of the impact of COVID on your portfolio. Look, I mean, I think largely, as I said in the presentation, it's had a really positive impact on our portfolio. Now, that spike in revenue and that spike in acquisition interest, there's a lot of M&A activity right now. So there's a lot of companies looking for good opportunities, companies that are looking for technology solutions to solve problems that they have right now. That won't last forever. But fundamentally, what we want to do is grow great businesses that will be acquirable eventually. I think the foundations of any business we invest into, regardless of COVID or not, they should be great businesses because the underlying management team is excellent, the proposition is good, and they've got a product that is in high demand, addressing a scalable market, and those are all things that will exist throughout COVID and beyond. So we're relatively bullish. I think, as I say, COVID's had a positive impact. And we'll obviously just have to wait and see for how long it takes to unfold and unwind itself and move into a sort of a more normal world. But we're largely positive about life.
Okay, thank you. And James, just out of time, but I wonder if you could just wrap things up on your view on the post-COVID world then.
Exactly the same. EIS, James Faulkner mentioned it, EIS invests into a different type of business, and these aren't typically the companies that, I mean, maybe hospitality excluded from this, but these aren't typically the type of companies that are sort of really damaged by fundamental change. They're typically the companies that thrive and do well from it. So apart from the difference of carrying on as people are and not propping up the losers within the portfolio and actually funding businesses based on the fact that they're doing well rather than the fact that they're running out of money, no difference really.
Okay, thank you, James. So I'm just answering a question live and nothing. So I think that's about all we've got time for today. we will make all of these presentations available. Please contact me or any of the team at CoInvestor if you'd like to see them, and if you'd like to follow up with any of the fund managers, then obviously we're happy to connect you. All of these funds are live on our platform, so please go in and have a look at their full profiles, where you can digitally invest and then manage these investments sort of all in one place. Is the hopefully the benefit to you of our platform. And I'd like to just really say thank you for everyone who's attended, and a big thank you to our five speakers with five fascinating and diversified funds. So thank you everyone for your time, and look forward to following up with each of you. Okay, thank you all.
Thank you very much. Have a great day.